Thanks very much, Brianna. We're very excited to have Craig Martin here, and the topic is diversification, very important in any high-risk asset class. The research on angel investing really began in earnest in 2005, 6, 7. The first reports were issued. We learned a ton, and that's a lot of what's guided Keiretsu in terms of making sure our investors have access to a lot of opportunities. Because as Craig taught me many years ago, diversification is your only protection. We can't predict the future. But if we are diversified, it's going to give us a much better chance for success. So Craig is the president, founder of the Family Wealth Consultants, a family planning firm that's very different because they very much engage angel investing, alternative investments, whereas most of your RIAs do not engage with alternatives and nearly to the extent. So Craig's definitely a rare commodity on the entrepreneurial side. He's been coordinating estate, income tax planning, cash flow for high net worth clients right in the heart of the Silicon Valley since 1976. So he's certainly seen the rise and expansion of the venture ecosystem down in the Valley, and really can share with us some of his perspective on diversification as it comes from that kind of an entrepreneurial environment and what it means. So Craig's been with us since 2005. He's been an active angel investor and member of the Keiretsu Forum Silicon Valley chapter. I've worked with him on numerous due diligences and quite a few different co-investments along the way. So we're excited for a number of those results to be coming. He manages a fund, the FWCG Opportunity Fund, a diversification tool for his clients to invest in dozens of different opportunities. And has a master's in science. Great guy, a lot of fun, seen a lot of things, and excited to have him share some of his experience and why diversification is so important to angel investors. So, Craig, if you'd like to come on in, we'll have Brianna stop her share and let you start your screen share and take us away with the diversification presentation for today, and then we'll open it up for some Q&A.
Thank you so much, Nathan. That was a splendiferous introduction. And your choice of diversification for the word this month is a very important word in the investment business. And some very important people have said tried to emphasize the importance of diversification and have said some things about it. I've quoted here. We have trademarked the term diversification is your only safety. Yes, Nathan, it is true. So diversification is as easy as diversifying by numbers. In other words, we suffer business risk when we buy a stock out of a company, whether it's publicly traded or as an angel investor in a private company. The difference is that that company can go out of business easier at the startup level than in the public level. And we call that business risk in the investment business. In the public market, it's easy to diversify away that business risk by buying a mutual fund or an ETF, a proxy of that. But as angels, we need to gather enough powder, allocate enough money to be able to diversify that. ACA has said that to diversify away business risk for the angel investor, we need upwards of 40 or more investments. So, if you're just writing $25,000 checks each, we're talking a lot of money that needs to be allocated into angel investments. Again, an easy way to diversify as an angel investor is to find a fund focused on startups. My clients use my fund, FWCG Opportunity Fund. Nathan, it's time for you to now say your fund.
We'll give a little update on the Keiretsu Capital Co-Investment Funds, diversification vehicle as well, and we'll get a little update on that a little later. Thanks, Craig.
Yeah, good. Okay. So as a fiduciary with responsibility for my clients' monies, we know that there are two benefits to lowering the volatility, price volatility of a portfolio. We call that managing the risk of the portfolio. If we can lower the volatility of a portfolio and maintain market returns, then we can increase your terminal value and your spendable income during retirement. But my clients talk mostly about peace of mind. If they know that their that when the market's going wild and their portfolio has less volatility than that market, they feel very, very comfortable with that. Peace of mind is a big issue. So if we plot risk and reward on an XY chart, return is on the Y chart on this presentation and risk is on the X axis. If we represent the market as by the S&P 500, a popular index, long-term volatility on the S&P 500 is about 18%. Means it goes up and down 18%, but it averages 10% positive return. That's over the longest period of time. So, person who taught us how to diversify. So if we look at this, how do we reduce the volatility of that S&P 500? The person that taught us how to do that is Harry Markowitz. What he said is mix dissimilar price movement asset classes. So classically, that's bonds. So we're back to this XY axis here, returns on the Y and risk is on the X axis. The stock portfolio, 100% stock portfolio plots close to 18% volatility with 10% returns. But the bonds have less volatility and less return. So bonds are not stocks. And we can reduce the volatility of this all stock portfolio by mixing bonds with it. And we can plot it on what's become the efficient frontier. So any portfolio that sits on this efficient frontier has the least risk for the expected return. So 20% bonds reduces the volatility from about 18 down to close to 14. But the returns drop also, notice. As we add bonds, we approach the risk-reward ratio of bonds, with the most efficient portfolio being approximately a 70-30, okay? Most efficient meaning it has the lowest risk, 7% risk, excuse me, less than 10% risk, and the highest return, close to 7% return. So the ingredients of that chart are what make up that efficient frontier, but there are many parts of those ingredients. We call them asset classes. So US stocks are one asset class. International stocks, developed nations, are another asset class. Emerging markets are another asset class. Each have their own risk-reward ratio. So small cap US stocks individual stocks have huge volatility and higher return than US large cap stocks, which have lower volatility and lower return than small caps. Bonds have less risk and less reward depending upon whether they're corporate or government. So we can mix these together into a portfolio and end up with an inefficient portfolio. Or if we're smart, use the computer nowadays, push the button and does all these mathematical equations for us, we can build an efficient portfolio that sits on the efficient frontier. My goal as a fiduciary with responsibility for my clients' money is to move that efficient frontier at least to the left and hopefully up. So demonstrate how that looks. The blue line here is the efficient frontier for 100% stocks contrasted with 100% bonds. This dot in the middle might be a 50-50 allocation between stocks and bonds. So my goal is to reduce that price volatility and move that efficient frontier to the left, or maintain that risk and increase the return. Either get same return for less risk or more return for the same risk. But the only way I can do that is with alternative investments. I can't move this stock bond efficient frontier to the left by using just stocks yet. Nobody's been able to do that. So what are alternative investments? Anything but stocks or bonds? It's the best definition I think can be used. As angel investors, we are absolutely making investments in alternative investments. They are not publicly traded stocks. Direct real estate is an alternative, market loans to people or businesses. But you know, it could be oil and gas, infrastructure, pipeline, anything that you would make a direct investment into. The reason we use alternatives is because they are not stocks or bonds. So by definition, they have dissimilar price movement. They will move the efficient frontier to the left. I can move that efficient frontier up by finding inefficient markets. So inefficient markets are where we can expect increasing returns and higher returns than just the market provides. So the market, public market, is efficient. That means all the information that's known about every stock is included in every trade. That makes the assumption that that information is widely and freely available to everybody, which for the most part it is. Insider trading is illegal, in contrast to angel investors. When I tell my associates in my business, I trade on legal insider information daily. They don't know how to process that. That's not in their reality. ACA says the average return for the angel investor is 25%. When the markets return 10, that's an inefficient market. That declares to me that this is an inefficient market. I think Nathan is using a 26 or 27% internal rate of return when he speaks about it. So we're in that category. I have 107 addresses inside my fund, real estate addresses inside my fund, and all the addresses that have sold have produced a 15% IRR, most in the 20 to 30% range. That's inefficient. I can't find people in the public stock market that can do 15 or 25% return consistently. So who says they can move the efficient frontier to the left and up? BlackRock's one of the bigger investment managers in the world. They start with a 70-30 traditional portfolio, stocks and bonds. And if they add 15% alternatives to it, they declare they can move that efficient frontier to the left and up. That's true with a 60-40, a 50-50 traditional. Any traditional portfolio can be moved to the left and up by adding a minimum of 15% alternatives to it. So who's the most famous at that? My mentor is Dave Swenson at Yale Endowment Center. When he took over in 1985, endowments in the, alternatives in the dark green, small part of the total portfolio, and grew that concentration in alternatives significantly to the point where less than 30% is now in stocks, 70+% are in alternatives. So this chart of performance by Dave Swenson at Yale demonstrates several things. The green line says that if we use alternatives, he's getting far superior performance to a traditional 60-40 portfolio. But an important notice is that for 5 years, he did not. Why? Well, you understand, you buy a piece of real estate, you add value, you increase rents, and then you sell it. Well, at this point, when he sells it, Dave's now recording that in his performance. So it takes time for a non-marketable alternative to mature in many cases. Let's look at what could be a classic portfolio allocation using alternatives. In this particular portfolio, I've used 25% alternatives, but I've divided the marketplace up by asset classes. So each of these asset classes have different risk-reward ratios. We saw that over here where US stocks, small stocks had lots of volatility and more return than large caps, et cetera. So when we use a diversified portfolio, U.S. large and U.S. small are two different asset classes within the stock asset class. Same with international, developed markets, that large cap, small cap, and then emerging markets. This portfolio owns 9,000 globally diversified stocks, while that represents about 96 to 98% of the capitalized weight of the global stock market, which means we own the global stock market. So whatever the global stock market returns, this portfolio would earn those returns. The more alternatives you use in a portfolio, the more it will move the efficient frontier to the left and up. I've started with 25%. Let's take a look at what software reports for my clients. This is an actual client portfolio. This client's stock portfolio has this risk, about 18% that we're becoming familiar with, and about 10% return, becoming familiar with that. As we add alternatives to that portfolio, about 45% of this client's portfolio is in alternatives. And we've cut that risk from 18% down to closer to 9%. Notice that we've reduced the returns of the total portfolio because these alternatives are about 4 years new. We don't have the biggest part of our portfolio liquidating yet. We've been making investments over 4 years period, and we have few sales of our real estate or angel investments so far. Same is true with this client portfolio. The distinction is that we've moved a portfolio with 18% volatility way more than in half. Look at that. Took an 18% volatility down to under 8%. That's a monster move of the efficient frontier. The longer they hold these alternatives, the closer it will come to increasing that efficient frontier up to here. So always diversify away your business risk. You're not compensated for investing in business risk. Allocate into dissimilar price movement asset classes if you expect to reduce the volatility of your total portfolio. That looks like using stocks plus bonds plus alternatives, if you can find bonds that you like. If you're going to allocate more than 20% into alts, you're going to have a better chance of moving your efficient frontier at least to the left, and choosing the right alternatives, you'll increase that efficient frontier over time. And portfolio management software will report your successes. It's always good to look at the success of what you're doing in your risk management. Okay, any questions